Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My name is Kupfer, and I've been supporting deal-driven growth for businesses for 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the Deal Quest podcast. Let's get started. Hey, Deal Quest listeners, this is Kupfer here. As you know, every week we do a Deal Quest podcast. Every fourth one is a solocast, and this is one of those. So today I want to talk about something that was inspired a little bit from a couple of places. I saw something, a write-up of David Cho, who's an artist who did the original Facebook graffiti logo or the artwork, I think, for early on, and was going to get paid $60,000 for that. And then apparently he was convinced, he actually wanted the cash, not equity, but he was convinced that maybe he should take the equity, and he did, and it turned out to be worth over $200 million. And we hear other things like, some of these artists, right, Dr. Dre and others, with beats, who's the one? There's another singer or rapper that that's involved with one of the water products that become very successful. And you hear these stories of folks who take equity for services and get rich off of it. And so I thought I wanted to talk about, this is not the type of deal I've talked about previously on the podcast. I don't even think we've alluded to it or had guests on that, where we've delved into this. So I thought it'd be a good topic for us to talk about on this solocast. And, even if it's not at the level of some of these big rappers and other folks and artists, I think a lot of us, especially those of us who are in the service business, whether we are consultants or trainers or lawyers, or I certainly haven't come up because I do a lot of deals and people, ask me whether I want to take pieces of it sometimes or do equity instead of a fee. But I think it comes up for other folks too, right? Everyone from graphic designers to website designers, to technical people or whatever. And especially with, if you deal with startup or earlier stage companies where, cash is tight, right? And what they have to give, right? What the currency they have to give really is equity. And we can look at this from 2 points of view. I mean, one is, I want to quickly talk about it from the company point of view, where, that's the solution sometimes when you need certain services, cash to pay them for them to exchange it for equity. But I will tell you, I can't tell you how many times I've had clients who did that early on and regretted it because the amount of equity they gave away for the cash, in hindsight, they really, it was really worth a lot more than the cash. Now, listen, you could say that that's sort of genius in hindsight or whatever, but at the time, if that's your only option. But I always do tell people to be careful, right? If there's any way you can do things, for cash, watch the amount of equity you give away, because sometimes these early stage folks get such a big piece, and it limits your capital raising later, and it has people that aren't contributing on an ongoing basis, get capital. So that's from the company side. Well, let's talk about it from the service provider side, from the entrepreneur side, from whatever your business is. If somebody approaches you and says, hey, listen, I'd like you to take equity in my company, either because we don't have cash, we're a startup, or because, hey, listen, maybe you are going to be an ongoing integral part. Maybe it comes from a good place where, the entrepreneur thinks the company's going to be very, very successful and says, hey, why don't we align our interests and sort of take the ride with me? And you're going to help them be successful with whatever consulting or training or technical or, whatever it is. And again, it's more often services, although even in a product business, it's possible you could trade product, get product for equity. And that happens sometimes. I just see it offered to service providers a lot more often. So what should you do in making that decision? And what should you know about in making that decision from the service provider side, from the, who's being offered equity instead of cash. So there's a lot of things that, especially if you are not familiar with this stuff, where things can go wrong, or things to consider at least, and things to negotiate if you're going to do such a deal. So one is this. All right, equity is itself basically, an ownership right in a company, right? Whether it's stock in a corporation, or maybe more often these deals for many companies, it's a membership interest in an LLC, which is what the ownership in an LLC is called. In any case, you're going to get an equity piece, all right? But what does that really mean? You own 3%, 1%, 10%, whatever the number is of the company. Well, what does that get you, right? So let's talk about the characteristics of equity. Equity really can have three characteristics. Two are economic, and one is not. The one that's not is voting and control rights, right? Odds are, as a service provider, you're getting a minority, interest in the company. It could be very small, up to, somewhat larger if you're a key player. But it's going to be a minority interest. So, you're not going to end up controlling any decisions, and it's, just by ownership percentage. And it's very rare for somebody who's trading services for equity to get the kind of veto rights or supermajority, say rights that, for example, a private equity investor, a venture capital investor would negotiate, where they'll usually let the management run the company day to day, but on anything big like selling the company or raising capital, bringing in other owners, taking out, incurring debt above a certain amount, a bunch of big transactions, they're going to contractually have rights. So even if they only own 10%, well, with VC or private equity, it's probably higher, but if they own 10, 20, 30, 40, whatever the number is percentage, and they don't have control by, they don't own 51% of the company, they still get contractual rights to have veto powers over certain major transactions. It's very rare for a service provider who's trading time, or services or products for equity to get those kind of rights. So you have to understand that you are most likely going into a situation where you're a minority owner with no say in how decisions are made. So you really, really have to do your due diligence and be confident and comfortable that you trust management, which is something you should be doing anyway, even if you're certainly investing, even if you had certain control rights, because you're not running the company day to day. You want to do management is the single biggest thing that drives professional investors to invest or not is really the management team, often more than the idea, which can, obviously evolve. So you should know it's highly likely that if you're getting a small percentage of equity, you can have no voting or control rights whatsoever. Your equity might even be non-voting, but even if it is voting, you're going to be so outvoted that it doesn't matter. So that's point one. Now, equity has two economic pieces to it as well, which I mentioned. One is the right to participate in profit, right, and cash flow that comes out on an annual, or they might distribute it monthly or quarterly, whatever. But but on that basis, right, the cash flow of the company that gets down to the ownership level. In many startup companies, there's not a lot of that in the beginning, right? Maybe as they grow over time, they can start throwing off cash. Some businesses are actually not even designed to do that, because they're designed to, like, mainly in the tech field, where they're designed, let's say an online product or service, or, SaaS product or whatever, where they're, designed to get, eyeballs and maybe free downloads and with apps and that kind of stuff, to be able to build up eyeballs and then eventually sell the thing. And there's not a lot of cash while they're operating, but there are other types of businesses that are going to grow and throw off cash flow, and that's potentially available for distribution to the owners, including you as a minority owner who took equity in exchange for services. However, that's not guaranteed, because the executives, the founders and other executives, the team, the employees, whatever, can be getting paid compensation that could zero out the profit at the bottom line, and therefore make nothing available for distribution. So unless you can negotiate caps on compensation, salary, any sort of budget controls, which again, you may not be able to do. Again, I've had people who are providing a big enough set of services to folks where maybe they have negotiated this, but for the most, in most of these deals, you're probably not going to do that. So you don't have any guaranteed distribution, cash flow at the ownership level. Now, that also means that the other owners are probably not getting distributions unless they have a preferred equity that you may not have, which you have to look at as well. Are there multiple classes of equity? If so, what class of equity are you getting? How does it compare to the rights and preferences of the other owners? Does people have priorities over you on distributions? But even if you're in the same class of equity and everybody gets distributions equally, if the founders and major principals are also working in the business and taking out money through compensation, then it may zero out the profit, and they're not worried about getting money on the ownership level as distribution, which you would share in because they're taking it out in comp. So that's something else, to watch out for and be aware of. So now you may not have voting rights, you may not have practical distribution rights, unless you give yourself some protection. So what is the other piece? The other piece is the ability to participate in an exit, a capital transaction, right? When they sell the company, when they monetize, they have a monetization event in some way. And that's often what people are investing for, is to get that big, there's a promise of this big back end when they get to monetize, right? After they build up the company and they're going to sell it, or they're going to go public, they're going to IPO, whatever it is, right? So in that case, what you also want to look at is, okay, that's great. Maybe that's, you're okay, maybe not getting the voting rights and not being guaranteed at least any distributions. By the way, little asterisk. If the entity is a pass-through entity like an LLC or an S Corp, you want to at least make sure that there is a requirement to distribute at least enough to cover your tax liability, because in those types of entities, you're going to get taxed on your relative share of the taxable income, right? And get a K1 and have to pay tax on that, whether you get a distribution or not. So if let's say you have 2% of a company because you provided, did their website, provided legal services or accounting services or whatever you did, and the company has, $1 million in taxable income, but they're retaining it for future spending, right? Because they can reinvest, and maybe they're still developing their product or service, or they're expanding the marketing, whatever it is. So they decide not to distribute out. Well, even at that 2%, on $1 million that they're retaining, you're talking about $20,000 in income to you, for which you're not going to have the cash, right, to pay the taxes. So you're going to have a tax bill on that 20 grand in that example, and not have gotten any distributions to pay it. So it's pretty common provision. Even, it's just a common provision in operating agreements in general. So hopefully you want to check that that's in there to see that at least you're going to get distributed out enough to cover your taxes, right? They might put it in as a percentage, or say in the highest bracket, or they might say, 35, 40%, whatever the number is, depending on where they are in the country. And at least you're not going to be out of pocket.
Let's take a break from the show for a minute so I can invite you to a new way to determine your deal readiness. I created a fast and easy assessment that will determine exactly how deal ready you are. Once you complete the assessment, I use your responses to identify the obstacles that are holding you back from being a deal-driven growth genius. It's as easy as heading to CoreyKupfer.com/assessment. That's CoreyKupfer.com/assessment, and filling out a few multiple choice questions. I'll be checking in after the episode to see what your results are. Now back to the show.
So now going on to the third piece, which is monetizing on a sale or something like that. Well, okay, that sounds great, right? They're going to sell the company now for $10 million, and you have your 2%, you're going to get 200 grand, and everything's great, right? Well, maybe not. First of all, if they're going to sell, are they going to, what has happened in between now and then? Or if they're going to go, IPO, go public, what has happened between now and then? At the time you have bought in or exchanged your services for equity, maybe you do have 2% of the company, but now they needed to raise additional capital as they went. Maybe they issued some additional equity to key employees, and maybe your 2% is now diluted down to 0.2%, right? So now, on that $1 million that I talked about before, you're not getting 20,000, you're only entitled to 2,000. Now listen, hopefully anytime the company is diluting equity, because remember, the founders are diluting themselves as well, unless they have some preferred class, but if they're in the same class as you at least, and very often even their multiples, they're diluting themselves as well. So even if there is proportional dilution, first of all, they have a much bigger piece than you do. But you would hope that they are only doing that if it makes business sense, right? It wouldn't make business sense to further let in other equity holders, putting in other capital or services or whatever it is. And in my simple example, have a company that was worth $1 million and it's still worth $1 million. Your hope, of course, is when you bring in other owners and they are providing products or services, or maybe, it could be in connection with an acquisition, but however it is, that you're adding to the value, or you're raising capital, that you're adding to the value of the company, right? So, after my simple example where you have 2% of $1 million, which is 20 grand, let's take an extreme example. Somebody comes in with another $1 million of value, whether that's cash or, the company's worth $1 million and the merger's in, whatever it is. Well, so now you get diluted by 50%, meaning your 2% goes down to 1%. But hopefully it's now 1% of at least $2 million as opposed to 2% of $1 million. So you're at least equal in terms of what you're, even though you have a low percentage, what it's worth. But listen, that doesn't always happen. First of all, depending upon the cap table, the type of equity you have, the preferences other equity holders may have, the ability to issue equity to the principals and owners and employees, you may get disproportionately diluted in some ways, right? Also, the equity may get diluted at lower valuations, right? Now, that's the last thing that a company wants to do, is what they call a down round of financing. But if the company's not doing quite as well, if they're doing horribly, they're not going to be able to raise more capital. But if they're not doing quite as well as they projected, they might have to raise capital, and they get into a difficult situation. They may have to raise capital at a lower round, which could dilute you in a way that's disproportionate to the value that you bought in originally. So it may seem like I'm saying never take equity because I've raised all these issues, concerns, complications, things that can go wrong. And by the way, there are 20 or 100 other things that can go wrong. But I'm not necessarily saying that. And of course, listen, I'm a lawyer, but I'm not your lawyer to get legal advice. I'm not giving you advice on any particular deal here. So would I say never take equity for services? No, I would say almost never take equity for services, especially if you're like me, where you get pitched a lot on it, right? And a lot of these companies are unlikely to monetize. So when I say almost never, well, what are the criteria when you should consider it in my mind? Well, first of all, you want to treat equity for services the same way as if you got paid in full and then we're making an investment, because that's effectively what's happening, right? If you're supposed to get $10,000 for this project, and let's keep it simple to start with, and I'm going to talk about some other variations, and they say don't take it in equity, or right, that example I gave with the Facebook guy, it was $60,000, right? And he didn't take it in cash, he took it in equity. Well, you want to say to yourself, what he should have been doing, and he was leaning against, and then got advised, I think it was by Parker, he got advised to do it, and thank God he followed it, right? $200 million. But if he did the right analysis, he would be saying to himself, okay, if they paid me 60 grand, would I make a $60,000 investment in this company? And the kind of due diligence that you should be doing on any investment, right? In terms of its prospects, the management, the products, what their historical revenues are, what their projections are, all that kind of stuff. You shouldn't be doing anything differently if you're taking it for services, because it's the same thing as if you were getting paid and then investing it back. Now, if you're able to somehow mark up your prices above what you would normally charge, so that effectively you're not getting, not all of that is really money you would have gotten anyway, okay, changes the analysis a little bit, right? But if you can charge X and now you're going to take that in equity, then you should evaluate it as any other investment, like you were making a cash investment. Number one. Number two, what you want to do obviously is look at whether you need the cash or not need the cash. That's going to make a big difference, right, in terms of your risk profile. Number three, what I have done in the past more often when I've done this, and I've only done it a handful of times over the years with a lot of requests, because again, I got to vet the company, I got to vet the opportunity, I got to vet even the valuation, right? Even the company's great, the valuation might be outrageous. So I got to make sure it's a fair valuation. What I've done more often then is that I've considered taking a discount on my fees in exchange for a portion of equity. So I get paid for my services in a manner that covers my costs at least, and usually makes me some profit, but not my usual profit margins, because then at least I'm never really out of pocket money because I've covered my costs, and I will give some sort of discount in exchange for equity. And again, rarely, very rarely. So that's another thing you could do, is do a hybrid, right? Where even if you're not able to, punch up your fees about what you usually charge, is you can take, let's say you run on 40% margins, so that, on a $10,000 project, you make $4,000 in profit normally, and, you have $6,000 in costs. If you take at least the $6,000 in cash and convert the other $4,000 to equity, at least you're at a minimum break even, right? You can do 8,000 cash, 2,000 in equity, and now you're making half your profit margin, and then you put you're investing the other half back into the company. So that's another possibility for what you can do in terms of reinvesting, and taking equity. The other thing you want to take into account, is what position you're in to evaluate. Just because you're providing services to this particular company doesn't mean the industry enough to evaluate it as as an investor, right? And also sometimes the timing on this stuff is quick. So you're going to want to make sure that you really do that. The mistake I have people, like I said, there are times when it makes sense to do this, and I've actually done well in some of these investments. Not Dr. Dre beats well or Facebook artists well, but pretty well. But the thing I find is that a lot of people who are less sophisticated in this, they're not really used to doing deals. They know their business. They know how to design a website or to provide tech services or to be a lawyer, even, or to be an accountant. And, and they just take a flyer, right? And there's no due diligence. There's no analysis. There's no really understanding of the cap table. There's no figuring out whether the valuation they're getting is fair. There's no checks and balances on, their equity, getting diluted, or even understanding that it could be. But they just get excited about the company and they think they're going to get rich. And in most cases, those investments don't turn out too well. So those are some of the things that you want to take into account. Those of us who get approached a lot maybe have done this analysis, but for you, it may be, for some of you, it may be newer. And I would say definitely get some professional advice if you're thinking about doing this. Now, listen, if it's some nominal amount and it's throwaway money, whatever, that's a gamble. But if it's any significant amount, then you want to treat it like an investment. And with an investment, you would do your due diligence. You would have your professionals look at it, your lawyer, your financial planner, your accountant, and you would make that investment decision separate and apart from everything else that's going on. So, folks, that's it for this week. Little thought on taking equity in exchange of services and whether that deal makes sense. And we will be back next week and the next few weeks with guest interviews with another solocast to come in 4 weeks. Have a great day and a great week, DealQuest community. Take care.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the DealQuest community. Join the DealQuest Deal Den Zoom calls, a free monthly 90-minute mastermind. In the mastermind, we address all the challenges you may be facing and help support you with the opportunities that may arise in terms of deal-driven growth. You will get input not only from me, but all the members on the call will collaborate and serve each other in a mastermind format. To sign up for the free mastermind, go to www.corykupfer.com/dealden. That's corykupfer.com/dealden. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.